Welcome to TaxWit's Wealth Protection Podcast, where we demystify the legal and tax issues surrounding wealth creation and protection. The content presented in this podcast is for informational and educational purposes only. Should not be construed as legal, financial, or tax advice. While the hosts and guests may be legal professionals, they're not your legal professionals. Laws and regulations vary by jurisdiction, and the information discussed in this podcast may not be applicable to your individual circumstances. Always consult with a qualified professional for advice tailored to your unique situation. Today, Whitney and I are going to do a deep dive into the options that you have if you owe past due taxes. So, Whitney, before we go into the options in detail, can you give us a brief overview of the IRS collections process?
Yeah, when we're talking about IRS and working with the IRS, you have to understand it's a big bureaucratic agency. And so we have the collection division, which is a totally separate division from examination. Examination are the people that come out and say, do you owe more taxes? Let's take a look at your books and records. And that's the audit group. Then you have the collection divisions. All they do is collect taxes. They don't really know anything about tax law. They're not CPAs or accountants. These are collection people that just want to file levies and liens and garnishments and get the money. So when you're in the collection group, so we're talking about people that owe money. They are not disputing what they owe. They're disputing how much they can pay today and over the next, so many years. So that's the collection group, and the collection process is, first of all, none of the collection employees and revenue officers, they're called ROs, revenue officers. So a revenue officer is a collection agent. None of the revenue officers can do anything at all unless your file, so that means a tax return for a particular tax year or a number of tax years, has been assigned to that collection agent, and it's in their inventory, they say. So an agent will say, that case, that year, those amounts due, that tax debt is in my inventory. If it's in their inventory, they have authority to do something about it. If it's not in their inventory, they have no authority, and they don't do anything unless your case is in their inventory. So once your case is in the inventory of a collection agent, they're going to call you and want to come pick up a check, right? But you can't pay them the full amount due. And so now there's going to be a series of processes. So what you have is the revenue officer. His job is to come pick up that check and wants to know when he can stop by. And then if you can't pay them, then there's a series of processes that that you kind of go through. So I'm just kind of laying the stage for, where we're at. So when a client calls me, hey, I got a phone call, or I came home and there was a business card on my front door, or a letter that says that, John Smith from the IRS is here to help me get my tax debt paid by picking up a check. So that revenue officer has very little incentive to do anything other than get all the money right now, and they don't really care. That's their focus. You're then going to say, I can't pay, and then you need to initiate and change the trajectory of that collection, of the collection process procedures, the actions that are going on. You need to change that trajectory. And so the question is, how do you do that, and what are the possible things you can do to change the trajectory of this collection agent thinking that he's going to come over and pick up a check? And that's kind of the overall view of what's happening here.
Okay, so for a collection agent to leave a business card or something like that, that would be for a higher balance, right?
Not necessarily. No, it could be anytime he gets a case assigned to him. He's going to go drop by, and a couple other things. That collection agent, if it's 10,000 or 50,000 or 200,000 or $1 million, the first thing he's going to do is he's going to stop by your house in all of those cases, because what he wants to do is he wants to know, who are you, what do you have, where do you live, what's your lifestyle. So the first thing that we do, even as a revenue agent, when I was an IRS revenue agent, and we're going to audit a client, before you know that I'm auditing you, I'm going to come to your house. Do you have a boat? What neighborhood do you live in? Is there a Mercedes parked in the garage? So I want to assess the lifestyle of that person. And so the revenue officer is going to do that. He's going to come over. He's going to stop by your house. He's going to knock on the door. And what he's doing, and it doesn't matter what you own, and they may not do that for the guy that owes, $6,000, but what they're doing is they're assessing, what is your lifestyle, where do you live, and they certainly would love to knock on the door and for you to open the door and be able to talk to you.
Okay, but it is also possible that you don't hear from a revenue officer, that you just get a letter. Is that right?
Yeah, that is possible too. So so you might get a letter from the automated collection group, so that it hasn't really been assigned to a revenue officer in your district. This is just an automated collection group out of Fresno, or one of the many automated collection groups in the IRS service centers. And they may just start sending out letters, and probably the first couple of letters you get, that's what you're going to get. You're going to get some letters from an automated collection group. This is a computer. You can't call the computer. There's no person that knows your name. This is a computer spitting out 1,000 letters every day, if not 10,000 letters a day, to taxpayers saying, hey, thanks for filing your tax return. You owe us, X number of dollars. Write the check payable to the U.S. Treasury, and mail it to this address. And then you'll get another one, and another one, another one. And then if you don't pay, then it might get kicked out to a person that's a live body, who's going to contact you on a more personal level.
Okay, so do you have to respond to those letters?
Do you have to? Not necessarily. Well, it all depends. I mean, if you have a check to pay it in full, just write a check and pay it, if that's what you want to do. If you don't, not responding or responding, I mean, I don't know how much difference it really is going to make, because what's going to happen is there are certain procedures that you want to, uh, to affect. You want to change the trajectory of this collection action, and you need a live person to do that. And so when you start getting those letters, I mean, if you call the computer, they're not going to say, oh, you want to engage in an installment agreement? Great. You need to file an installment agreement request. So before you do that, well, you can do it on your own, but what happens is they get denied, and then it comes to me, and the client says, well, here's what we filed. And I say, well, gosh, why did you make these disclosures? Because this isn't necessarily accurate or correct. This isn't the question, because the taxpayer doesn't know on the forms and the questions and the information you're supposed to submit, what is the IRS looking for? What is it that they want to know? What are we trying to accomplish? And what information is the IRS really looking for here? And when you don't know that, you're giving them information that is kind of misleading, and it makes it more difficult at the end of the day when you have a lawyer or a CPA that's involved in this type of industry that knows what they're doing. And when we're talking to the IRS says, but the taxpayer already told me this other thing. And well, That's not necessarily accurate because there's some other factors going on here, and here's what it is. And so they want to put you in a box. And so when you get those letters, if you want to into an installment agreement, or if you think that you might qualify for an offer in compromise or some other, if you're currently not collectible, if you want to do any of those things, you really need to have someone that understands how to present that to the IRS so the IRS agrees.
Okay. Is there any, so when you're getting these letters, is there any like specific language that you should be watching out for to kind of ascertain what letters are more important than others?
Yeah, so here's what's going to happen. You're going to get a letter from the IRS computer. Hey, this is the IRS Automated Collection Group. You owe $48,000. Please write a check. Hey, this is the IRS next letter. This is IRS. You owe $48,000. We sent you a letter already once. You didn't pay, so we're reminding you. Next letter. Hey, this is the IRS. If you don't pay us, some bad things might happen to you. Fourth letter. Hey, this is the IRS. We've sent you some other letters. You haven't responded. If you don't pay, some really bad things are going to happen. We're going to do some bad things. And then the fifth letter, we really mean it this time. We are going to do some bad things. We told you we're going to do some bad things. We didn't do it yet, but we really mean it this time. And then you're going to get the letter that's going to say, this is your final notice of intent to levy. So when you get this letter, this is the thing you're looking for, the final notice of intent to levy. When you get the final notice of intent to levy, you have 30 days. After 30 days, the IRS can garnish wages, levy your bank accounts. That means they just come in and sweep your bank accounts, and you walk, into the bank one day and there's no money there, and you're like, what happened? Oh, the IRS swept your accounts. Well, I didn't know. Well, they sent you all these notices and gave you your final notice of intent to levy. You have 30 days from the notice, that's the final notice of intent to levy, to then take some actions. And usually what you're going to do is file a collection due process hearing request. And that's going to stop everything. It's going to freeze everything in place. Then you're going to get an appointment to talk to an appeals officer, collection appeals, to determine whether the levy notices are proper. They almost always are, but and that's not really what you're going to argue. They weren't proper. They all are improper. They are proper. What you're going to argue is there's an alternative collection process that really suits the situation, and we want to engage into an alternative collection, procedure. But you have 30 days to file that collection due process hearing. If you don't, all bets are off. The gloves are off. They are now legally able, for the end of time until the statute of limitation expires, the IRS can at any time after that sweep your accounts, garnish wages, and do things without asking you or notifying you after that. They must give you all these notices first, and then once they satisfy their notice requirements, they can go do these bad things. So that's what you're looking for, is the final notice of intent to levy. You should probably have someone ready to go by the time you get there, or sooner, so that when you get that final notice of intent to levy, then you have some options kind of thought through, and you have an attorney or a CPA who's knowledgeable to contact the IRS, file a power of attorney, say, don't talk to my clients anymore, only talk to me, and we're going to engage into some alternative collection procedures, and then you start that process.
Okay. What if someone said, "Hey, I didn't get the letters"? Is that a
Yeah,
valid legal argument?
definitely not a valid legal argument, because the way it works is, and that happens all the time, by the way. I moved. I don't, that house was foreclosed, or I sold that house and I moved. But you know what? You didn't file a tax return in the last 3 years and tell the IRS that where you lived. You changed addresses, so they're mailing those notices to the last address that they have on file for you, and you didn't get them, your fault because you didn't tell the IRS where to find you. Almost nobody does. And so the IRS, under statute, they're required to send the notices to the last place that they know of where you live. And if you don't live there anymore, you didn't get the notices. Next thing they swept your bank accounts. And that happens sometimes. The clients come in my office and they say, I didn't get any letters. I didn't get any notices. Then all of a sudden, my bank account had, $16,000 in it, and I need that account to pay all my medical bills and my business expenses or whatever. And now there's $0, and I bounced 14 checks, and everyone's mad at me, and my car payment didn't, go through. They can't do this. This isn't fair. Well, they can do it because they sent the notices to the last address where you told them you live. And if you don't update that contact information with the IRS, you might not get those notices. And so that's a little danger spot. The other thing that happens quite a bit is clients walk in my office, maybe before or after the IRS has garnished or filed a garnishment. And usually it's like, my employer got a garnishment. And why did they do this? And I say, well, have you received any notices from the IRS? And the IRS and the client walks in my office, and they have 6 pieces of mail from the IRS over the past year. All of them are not opened, and that happens quite a bit. I mean, it's a lot of anxiety to open those letters. They know what's there. They don't want to face it, and they just don't open the mail. And they walk in my office and hand me these, 6 letters, all of which are unopened, and I open them, and that's all those letters saying, hey, you owe some money. When can you pay? We already sent you a notice. You didn't respond. We're going to do some bad things. We really mean it this time. We really, 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 really mean it this time. We really, 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 really mean it this time. Okay, now we're going to do it. It's your final notice. And then the next thing, the last letter that I open up is, here's a copy of the garnishment that we sent to your employer.
Yeah, I can definitely relate to that, not wanting to open the letter. I got back when I was in college, I used the IRS information to pre-fill my FAFSA form. And then I got a letter from the IRS just notifying me that my information was used to fill out the FAFSA form. But when I got the letter, my heart still sank
Yeah.
because you see the IRS logo and you just think, oh no, like what is going to be the result of opening this letter? So I can definitely, understand that. What are some so not getting the letters because they didn't keep the IRS updated with their, current mailing address. That would be one reason someone falls behind on their taxes. What are some of the other common reasons that you see that people get into trouble when it comes to past due taxes?
So when we're talking about past due taxes, I mean, it kind of comes in a couple flavors. Sometimes the collection agents are coming out saying, you haven't filed a tax return in 4 years. And so we're here to pick up your, 22, 21, 20, and 2019 tax returns. When can you get those filed? So sometimes they're just asking for past due tax returns. Other than that, it's you owe some money and you haven't paid it. And how did you get there? It might be the question that you're asking. And how do people get there? So many different ways. I mean, I had a client call me yesterday morning, and he said, I just got married, a year ago. I sold a business that year. Has nothing to do with my new wife. I made a lot of money for a lot of reasons. I don't have the money to pay the taxes. I owe almost $1 million. There was a lot of phantom income because of the way things worked out. And I'm going to file my tax return now. I don't want it to affect my, new wife. What do I do? I mean, that happens. I had a client that I've been working with for several years now. He was a lawyer before he retired, in a big city, big law firm, made a lot of money for a lot of years and lived a nice lifestyle, but didn't particularly save his money. But there came a time in his life where he spent about $1 million in legal fees defending the children of his new wife that he adopted, and because their father was an abusive person committing some crimes against those children, and they spent several years in litigation. And instead of paying his taxes, he felt it more important to um, defend these two little girls and get custody, and in fact be able to legally adopt them away from that man, and then to be able to get them into a more healthy living environment. You know, next thing you know, but he didn't pay his taxes over the course of 2 or 3 years because he was spending all this money on legal fees to do that. Right or wrong, he still owes the taxes. So, however you get there, a woman called me yesterday. She didn't file, 1 year, I think 2018, but has filed all of her other years, but just hasn't been paying, and just kind of ignoring the situation because too much anxiety to think about it. But she has a W-2 job, but she has a little side hustle, and she's getting 1099s, but she really wasn't keeping track of her expenses. So it looks like she made an extra $80,000 a year, but she didn't make an extra $80,000 a year. She had, $60,000 of expenses and made an extra $20,000 a year. But the IRS doesn't know that because they're just getting the 1099s, and she didn't, put that income and expenses on her tax return. She just filed her W-2s, and she didn't really know how to do it. She didn't have an accountant she was working with, and you know, however people get there, it happens a lot of ways. The common story I hear is something happened in 2017, and I had a health problem. I had, a lot of depression or whatever it was. And I didn't file in 2017. So in 2018, I didn't file my 2017 return. So then when my 2018 return came due, I didn't know what to do because I hadn't filed my other return. I felt if I filed something, I just alert the IRS I hadn't filed my prior year, and then they're going to come out and put me in jail. So I didn't file, and then next thing you know, here it is. It's 2023. I haven't filed a return since 2016 was the last return I filed. So I haven't filed a return for 17, 18, 19, 20, 21, and 22. That happens a lot where someone says, I didn't file this one particular year for whatever reason, and then next thing you know, I just didn't file any since then because I didn't know what to do. That's a common occurrence.
If you're there, you're there, and you need to work it out somehow with the IRS. So you're talking about what you said before was you want to change the trajectory of this collection action.
Right.
So you said the first step usually is requesting that collection due process hearing. And it sounds like the benefit of that is it gets you in front of a actual person. You said it's an appeals officer.
Yeah. So here's what you're looking at. You have a collection agent, a revenue officer. That's the person. We call them knuckle draggers. Um, that's the person that's going to come out and help you find your wallet so you can give them all your money. That person has a manager, and so we have a group manager that has 10 collection agents that are underneath him in his group. Um, that group manager then has an area manager and then a district manager. That's kind of that's kind of hierarchy. But you have this separate group over here called appeals. Let me tell you, collection appeals is not that independent. Technically, they are. They're supposed to be. Um, the collection appeals people. So in examination, the appeals people are all CPAs. They're accountants by trade. Some of them are lawyers. Um, these are people that are pretty smart, have been around for quite a while, around the service. They know what they're doing. They're really going to take a look and get to an arrangement that works. Um, making an agreement that that the taxpayer can't fulfill doesn't help anyone. The collection appeals person is not necessarily an accountant or a lawyer. They're usually tenured revenue officers, which isn't really the best person to be in appeals, because those revenue officers that worked for the IRS for 20 years and now they're an appeals person, their perspective is, why is not the taxpayer paying the money? They owe the money, and I don't care what, they need to give us the money. Your kids are in college, or you're sick and have doctors, or you have a mortgage. We don't care. Sell your house, default on your mortgage, give us the money now. And so they've been indoctrinated into that way of thinking because they were a revenue officer for so long. That's hard for them to kind of move past that and understand, we need to put you into a position that you can fulfill. We need to get you into a payment plan you can actually pay. The inflation that we've had in the last 4 years has been so incredibly high. The IRS budget of what they say taxpayers should be able to live on is just not realistic. No one can live on the budget that the IRS says, here's our national standards. We can talk about national standards at some point, but the national standards of the IRS is a budget that you probably could live on in 2003, but not very many people can live on that budget in 2023. So you have this collection appeals person that you're going to get in front of. That's the objective, third party that's going to consider, are there some other processes, collection alternatives that we can, move forward and resolve this issue. Some in a part pay, maybe in a full pay situation, but is there another procedure? And that's the person you're going to be talking to.
Okay, so let's kind of go through the different collection alternatives, if you will.
Okay. Well, the first step is an installment agreement. So you owe an amount of money, and it makes a difference if you owe more or less than $50,000. And that's kind of the magic number. If it's less than $50,000, you can go to the IRS and say, hey, I owe $50,000. This is for a 2021 tax return. Today is 2023. That tax return was filed in 2022. It's a year old. So the IRS, and this is important, the IRS has 10 years from the date of assessment to collect the tax. After that 10-year period, the statute of limitations expires and the IRS cannot enforce that tax debt. So in this example, now the IRS has 9 more years left on the statute of limitations. So we owe $50,000. There's going to be some additional interest as we move along. So the amount you might pay is, maybe the total amount, it might be $60,000 with interest over the next, time. And so you're going to say, hey, if we take that amount, divide it by 8 years, and let me pay over 8 years, the payment is X number of dollars. They're not really going to agree to that. The IRS wants you to pay in 24 months, and then you're going to have to argue with them. They'll let you go, I think, 60 months and maybe 72 months. They're not going to let you go more than 72 months, and that's if you have that much time left on the statute of limitations. So your best case scenario would be, hey, I owe you 50 grand plus some interest. Let's divide that payment over 72 months, and I'll enter into that agreement that I'll make that payment. And the IRS says, great, here's how it works. You need to tell us where all your banks are. You need to tell us where you work. You need to give us some information about you so that if you don't pay, we can come and put a lien on your house. We can garnish your wages. We can sweep your bank accounts. But we're not going to do that unless you stop paying. But let's get into an installment agreement. We'll divide that payment over 72 months, and we're going to direct deposit. We're going to have you have a direct deposit agreement. So your bank account is going to make that transfer to the IRS on the, pick a day, the 5th day of every month, the 20th day of every month. You can tell them what day you want. The 20th day of every month, I want to make my payment, and there will be an automatic debit in your bank account on that day for 72 months or until the amount is paid in full. Now, that's if you owe less than $50,000. So once you're more than $50,000, the IRS says, okay, different process. Here's how you start. File a collection information statement. It's a form 433A for Inter-Revenue Service. And if you have a business, you also have to include 433B. And so the collection information statement says, here's who I am. Here's all the people in my household. Here's some background information about me. Here's where I work. Here's where my wife works. Here's my children. Here's their ages. Here's everyone's social security numbers. Now, let's talk about my finances. Assets and liabilities. That's one piece of it. Income and expenses is another piece of it. Assets and liabilities. We're going to give all of our assets and proof of all of our assets. I have a bank account at this bank. Okay, give me 3 months bank statements for that bank account. So we have the 3 months of bank. Well, I have 4 bank accounts. All right, great. We want 3 months of bank statements for every bank account that your name is on. Well, this bank account really is my daughter's bank account. I opened it for my daughter when she was 12. Now she's in college and she's, 22. And but your name is on that bank account. I want, the IRS wants that bank account. Any bank account that your name is on, if you're a signer on it. My mom has a bank account. I'm a signer on that account because she's getting old and I'm helping her pay her bills. Disclose that to us. And if you have a car, title to that car, your loan documents, your lease documents. If you have real estate, show me a deed to that property and any debt on that property that you have, your mortgage payments. Disclose all that. Show me statements the IRS wants. So every asset that you own, life insurance policy, you have cash value in life insurance policy, the IRS wants all of those all that documentation. So you are opening the books entirely to the IRS. It's intrusive. It's uncomfortable. But if you owe more than $50,000, that's the process. Now we go to income and expenses. What are your income and expenses? Income from any source derived, and then cash flows. They also want to know if you have cash. Does your mom make a loan to you or a gift to you of $10,000 a year? Show me that, and show the transfer from your mom's account to your account, and show that that's a gift or a loan. So if you say, okay, so here's all my income. I work at this location. Here's my pay stubs. This is my employer. I have a securities account at Merrill Lynch. There's X number. Here's my bank. Here's my account statements. This is all the assets that I have at that account. Here's the name of my broker. Here's the statements. And so you're going to give all that information to the IRS. Now, so IRS says, okay, here's all your income or sources of cash flows. What's your expenses? Okay, well, I have my rent or my mortgage payment and, food and groceries and car and insurance and all this stuff. Okay. And your expenses, well, are, you have a budget of, $6,000 a month, $7,000 a month, okay, well, the IRS says we have this thing called national standards. Just because you have a Ferrari and your car payment is $2,800 a month doesn't mean that, and I think that's cheap for a Ferrari, but that doesn't mean that we're going to allow that. So sell your Ferrari, get yourself a Honda Civic. They're nice little cars. Have a $380 a month payment. and then you can pay the money to us, the difference to us. And so they have this thing called national standards for how much money you should be spending on groceries, how much money you should be spending on car payments, and so you have the cost of ownership and the cost of ownership and the cost of maintenance of that car, or operating costs. You have the cost of where you live, and you say, my mortgage payment is $4,300 a month. Great, we're going to allow $2,200 a month. So get rid of your house. Don't pay your mortgage payment anymore. Are you telling me then that I should default on my mortgage payment? No, we're not telling you that. We're just telling you you can't pay $4,300 a month anymore. Well, if I don't pay $4,300 a month, I'm going to default on my mortgage payment. We're not telling you to default on your mortgage payment, but we're not going to allow you to pay $4,300 a month. Well, how am I going to stay in my house?
So they're
if I
telling you to
can't pay the mortgage?
downsize.
Yeah. And I don't know if you've tried to rent a place, but I'm going to tell you, my kids are in college. My son and daughter share an apartment. It's about a 1,000 square foot apartment, 2-bedroom, 2-bath, and it's $2,170 a month I pay for that apartment. A family can't live there. It's hard to find an apartment that you can rent in most places, unless you are in a very undesirable, location. Uh, you know, and so that's the difficulty that we have, is now we're trying to negotiate how much can we pay. So the IRS says, right, you make $60,000 a year. We allow you to spend $40,000 a year on personal living expenses, and that's after this is including taxes, right? So that means you have $20,000 less taxes to pay the IRS. Say $20,000 after taxes is $14,000, let's say. So you can pay $14,000 a year to the IRS, and that is about what, $1,200 a month, or something in that range. So $1,300 a month. So um, that's kind of how it works. And then, but the client is saying, well, hold on a second. I don't have an extra $1,300 a month in my budget. Honestly, at $60,000 a year, less taxes, I'm living paycheck to paycheck in 2023 on that amount of income, and I can't pay $1,300. I don't have it. And that's where your lawyer comes in and tries to negotiate a deal and get variances for different things, and make those arguments, and so that's where the difficulty lies.
Okay, so when you talk about an attorney, or when you refer to an attorney negotiating for variances, you mean you're asking the IRS to accept expenses that are higher than those allowable amounts?
Right.
Okay.
You have your actual expenses, and they have the national standards, and you've got to persuade the IRS to get somewhere closer to your actual expenses, so that you can get into an agreement that works. Like I said earlier, it doesn't really do any good to force the taxpayer into signing an agreement that they definitely cannot pay. So you've got to, get to a place where here's an amount that I actually can pay. And so when a client walks in my office, the first thing I ask them is, well, I mean, not the first thing I ask them, but when we're going through this process, what I'm going to ask my client is, what can you comfortably pay? And it's going to be X number of dollars. Then I'll say, now, if we had 6 months to change some things, you have an apartment, your apartment is, or you're renting a house, and it's X number of dollars. Could you, when that lease is up, could you get into a different lease at a lower rate? Do you have this car? Can you sell that car and get a different car? Um, what can we do in your personal living expenses, in your lifestyle, that we can kind of cut some things down for a little while, so that we can free up some money to pay the IRS. And I can tell you, a hot topic a lot of times is the IRS says, well, you're paying like $1,500 a month for your kids to go to college, right? And that's not a particularly expensive college. Um, yeah, we don't allow for that. Your kids don't need to go to college. You need to pay the IRS. And so that's always a hot topic. And the parents are like, no, I've got to give my kids an education, or else they need to have an education to have a place in life that they can, a base and they can move from. The IRS says we don't really care. You need to pay the IRS. And if you don't pay the IRS, then we're just going to come and take things. And so you have this struggle of trying to get the IRS to agree to allow you to live a lifestyle that's now. When we're talking to this example, Ben, that I'm talking about, someone's making 60 grand or 70 grand or 80 grand, right? I'm going to give you two different extremes. I make $40,000 or I make $400,000. Okay, so let's talk about these two extremes. The first one is the easier one, the 40,000. There's a thing called currently not collectible. So if you can convince the IRS that even looking at national standards or some reasonable variances from the national standards, you don't have any additional income to pay, then the IRS will say, okay, you are currently not collectible. So we're going to put you on CNC status. I think the code on your tax module is a code 530, I think it might be. But once you get put on currently not collectible status, the IRS leaves you alone. Great. When you start making more money, the computers see, hey, you just filed a tax return, you're making 300 grand. Now they're going to send you a letter saying, hey, your finances have changed. You can start paying us again. Let's talk about it. So that's when we're making less. Now, when we're making more, and here's what happens a lot of times. Client walks in the door, their husband and wife combined income is $290,000. And $290,000 sounds like a lot, but in 2023, and they have, 3 kids, 2 of them are in college. One of them's a minor. They're in, sports, and they have extracurricular activities. Uh, they have life insurance policies. They live in a, upper middle class neighborhood. They own their house. They just bought it. The prices of housing has gone up, and the interest rates are up. So that cost of that house is, higher, right, than it was 5 years ago. And so, but they're not living extravagantly. They're living a nice middle class to upper middle class lifestyle. But they spend all their money after taxes on that lifestyle, and they don't have a lot. So what the IRS does is they come in and say, well, let's see, for a family of 5, we're going to allow, $60,000 a year. You're making $290. That means there's an extra $230,000. Heck, you can pay $15,000 a month. And the client says, no, I can't. I can't pay $15,000 a month. I might be able to swing $2,500 a month. No, $15,000 a month is what you're going to need to pay. So sell your house, move into a 4-bedroom, 3-bedroom apartment somewhere, your kids can bunk. And that's what and so now we're fighting against that. And that's a lot of times what we're fighting against is those types of situations. There's different situations too. And I don't know if you want to talk about some of the higher net income or higher wealthier clients that walk in, but there's kind of a different strategy when it comes to the higher net income people. But we see a lot of times this kind of in between, that these aren't rich people. You kind of think, if you're making $250,000 a year, you're rich. But a family with 3 kids is not rich. They're comfortable, but they don't have an extra $10,000, $15,000, $20,000 a month to hand the IRS, because they're spending that money on that upper middle class, not high class, upper middle class lifestyle. And you can't just call all of your creditors and say, oh, by the way, we're not going to pay you now. It doesn't work that way. You know, you have a car lease, you have, or a car loan. You can't just say, hey, I'm going to give it back to you and just, call it quits. It doesn't work that way. So it's difficult to transition that client into a lower cost of living, and also get the IRS to allow for some of those expenses. And, there's, ways we talk to the IRS, but, usually when we get to the appeals person, we're telling them, hey, look, you can put this client into a payment plan that makes you feel good and yay, we did it. They're going to default within a month. They can't pay this. They're not going to. It's not doing a service to the IRS, and it's not doing a service to the public to, force people into things that are just not going to work. You can't set them up for failure. We need to set people up for success. And if we're going to set them up for success, and so what do? Well, how about the first year we have a smaller payment, and then over that time they will readjust some finances, and then the second year the payment will go up, and then over that time they can readjust some other expenses, and then in the third year it goes up a little more. Sometimes we can get them into some type of arrangement like that. The problem is the IRS installment agreement contracts don't provide for that. This is outside the box, and in a lot of times when we're doing this and we get a revenue officer to work something out like this with us, they've never done it before, and the documents don't have this option, and so they've got to create something, and they got to get manager approval, and so sometimes we can work things like that out, but it's hard, and it takes a lot of time, and um, you know uh, I don't know how other people go about it. I'm told that I mean, there's, and I hear other people bragging. I talked to the IRS and I told them to go screw themselves, and I don't take their calls, and I take it and I call them, and I want to talk to their manager, and I want to talk to their manager's area director, and when they come over, I put them downstairs in the parking lot where we have a little storage place, and I got a desk down there, and it's hot because this is Arizona and in the summertime, and here they are down there. I tell them, if you want to look at documents, that's where the documents are. And I don't know. I don't know if that works. I know people do that kind of stuff and punch the IRS in the face. I can tell you this: I was an IRS agent for 5 years. I treated people the way they treated me. Okay, I had I had lawyers and CPAs that treated me that way. And so they punched me in the face, I punched them in the face. And when I punch them in the face, it's really kicking their clients in the lungs. And I don't think that that's really doing a good job for the client. So you need someone that's going to fight and be firm and really aggressive. But, in my style, personally, I go to the appeals people first. The revenue officers, you can maybe treat that way a little bit. Some of them, not all of them, but some of them you can be pretty aggressive to, because they're that way to you. But not all of them are. But you got to get to someone that has some more freedoms. The revenue officers really don't have a lot of flexibility. Their managers a lot of times are telling them, go do this. And I'll have that revenue officer come out and he says, I don't want to do this. This isn't fair. It's not right. I don't feel good about it. But my manager said to do this. I don't have any choices. So, this is what I'm doing, and you can do A, B, and I'll sometimes I'll have revenue officers that will tell me, Whitney, what you need to do is file this particular thing, say that particular thing, reference this particular Internal Revenue Manual citation, and trying to elevate it and get it to somewhere where someone is controlling this that's not my manager, because my manager won't let me do the right thing. And in order for someone to do the right thing, this is how you got to get there. I've had revenue officers straight up tell me that. Here's what I'm here to do, and this is what you should do to get out of this. So really what you need to do is get to a level of someone where they have some authority, some flexibility to do something outside the box, or to make a business decision, right? The client is not going to pay $15,000 a month. Not going to, can't. And we can force that agreement on them. They're going to default. So let's get to something that will work. And so, once you get to that person, so when I'm talking to appeals or group managers are really difficult. Those group managers are there because they don't care. They're going to force everything, and the group managers really aren't the best people to try and work things out with. I really try to get away from them. They're the most aggressive revenue officers that became managers is what happens, and that's how they became a manager, because they were the most aggressive person in the group. So you want to get to someone that has the flexibility to make a business decision, and then when you get to that person, you got to treat them well. You got to treat them the way you want to be treated. Okay, and so we're going to go to them and we're going to say, look, we want a successful resolution. Do you want this client to be back in your office next year, and the year after, and the year after, and the year after, because they defaulted every single time, and here they are again and trying to get back onto a plan? Or do you want to put something together that they can make, and they can meet those responsibilities over the next 3 years, 5 years, 7 years, whatever it is, and this will work, and this is the most the IRS is going to get, and so you kind of go with that, with that perspective. In my opinion, that's the way that I go about it. And a lot of times you get to the an appeals person that says, yeah, let's make the business decision, let's do what's right. Let's put something in place that's possible. You can't put something in place that's not possible. Here's what's possible. Let's move with that. And as things come along, and if they're making any more money, they can make some higher payments. And so that's that's kind of how we go about it.
Okay. Yeah, that was a really in-depth kind of overview of how you handle those installment agreement requests. Uh, so, but there are some other options out there, depending on the circumstances. Uh, Including, I mean, from my research, but before the show today, it looks like we got an offer in compromise. There's something called innocent spouse relief, and then of course, the undesirable option of bankruptcy. Could you kind of walk me through those three options, when they apply, and then kind of how it actually works out?
Yeah, yeah. So what's the first one again?
The first
Offer and
one is
compromise.
offer and compromise.
Okay. When people call me, they've researched on the internet, and they always ask, so can we do an offer and compromise? And so I had this conversation yesterday, and I have this conversation once or twice a week. So the person that calls me is 44 years old. The wife is 41. They, have combined income of $150,000 between the two of them, and a family, with 2 kids, right? So this is the standard, profile that we'll talk about. And he says, hey, I had this business. I sold my business. I made a bunch of money. Now, we had some medical issues with one of our children. We've spent most of that money. We had some debts that we got into, and some other issues that we had to kind of pay off. And now we don't have enough money to pay our taxes. And I'm not working in that industry anymore. And so now I'm looking for a new thing, and I'm not making a lot of money right now. Things are just fine. We can live like this. If it weren't for the IRS, we can live just fine. But we have this IRS problem, and so we need to pay them too and put that into the budget. I just can't. My income dropped from 300 grand to 75 grand, and so add with my wife's 75 grand, we're making 150. And so so what do? I heard this thing called offer and compromise. And so this is the conversation I had yesterday. And I tell them, you're not going to qualify. Last week I had the same conversation. The client's income was down to $50,000 at the moment. He's starting a new business. That business has, I've made a big investment into this new business. We're not making any money. I'm going to make some money, down the road, but I've got to build some things up. And, businesses often take some time to, to build so that they're profitable. And so, so offer and compromise. And the IRS is not going to accept that. Not going to happen. The IRS's view is if you're young and if you made some money sometime in the past, you probably are going to make some money sometime in the future. You don't qualify for an offer and compromise. We're going to hold on to our liability, our liens and levies against you. We're going to apply max pressure and get what we can now. And then when you start making more money, we'll get more. And we're going to get some money from you. And so they're not going to accept that. So who qualifies for an offer on compromise is the better question. So here's who qualifies. You have a health issue and you can't work in the future. You're 78 and you're retired and you had a stroke. You have medical bills coming up. You have some assets, but you don't have any income because you're not working anymore. You're retired. And so the question is, how much of our assets should we give the IRS? And how much can we keep to pay our living expenses for the rest of our lives? Those are the people that are going to qualify for an offer and compromise. Someone that does not have the ability, or I've never really made any money. Maybe I didn't pay my file tax returns for a long time because of whatever reason and my fault. Okay. But I never really have made any money. I've always made $37,000 a year. And I have a kid, in sole custody of that kid who's 12. And, we're struggling. Well, okay, the IRS doesn't view you as someone that has made money in the past and is going to make money in the future. And so maybe hey, I can go to my brother, I can borrow $25,000 and pay my brother back over some time, and then, pay the $25,000 today and, wipe off the rest of what I owe you. That person might qualify. But other than that type of a scenario, the people that qualify for offers and compromises most often are people who are older, don't have or incapacitated, don't have the ability to work, don't have the ability to earn an income, any substantial amount of income in the future, and has something to offer. Now, I see some of these clients come in my office, and I filed an offer and compromise. It was rejected. Now I want to go to appeals, and can you take this to appeals for me? And their offer and compromise that they filed was $1. Almost always, the IRS is going to say, why would we give up our right to collect from you in the future for $1? The $1 isn't going to do it. $10,000 maybe, but $1, the IRS is going to say, no, that's not happening. So the offers and compromises are really for people that are not going to earn income in the future or any substantial income, and we're making some attempt to make a payment as much as we could potentially, possibly make, by borrowing from friends or against our home or other things. Okay. Um, so the next one you mentioned is what?
Yeah, so the next one is innocent spouse relief, but I just wanted to bring attention to a known scam out there. According to the IRS website, is apparently there's a bunch of these what they call OIC mills out there that are marketing pretty heavily, saying that you can settle for pennies on the dollar, which is maybe why you see some of those offers where people are
Yeah.
putting a dollar on there, but it sounds like that's just not going to happen for the reason that you just said. I mean, they have no reason to give up their right to collect from you.
Yeah. So I'll tell you, 1 out of 5 calls that I get for collection, tax debt, issues. The client says, I paid $5,000, $10,000, $15,000 to, I'll say their names, but or I won't say their names. All the ones you hear on the news, and they have the cute little jingles, da, 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 you know, um, they pay them $10,000 and they didn't do anything. And now the IRS is more mad at them than they were before. Probably 1 out of 5 calls that I get where we're taking over a case, they paid 10 grand. It was a total waste of money. And the process that, this, the tax relief, group, promised them just isn't working. And then they got to pay me 10 grand or 20 grand, and they're like, well, I just spent $15,000 on this late night TV, radio advertisement, national tax relief group. And, that happens a lot. When someone calls me, I'm going to tell them, I'm going to have an initial consult with them, and I'm going to look at the letters they're getting, and assuming they're giving me some correct information about their finances and what's going on. I'm going to tell them, here's what's going to happen. This is going to work. This won't. The other thing won't. But this other thing is a possibility. And the two things, the one thing is going to work, and the one thing it's a possibility. Here's your chances. It's going to work out this way. You're going to say this. The IRS is going to say that. We're probably going to settle about in this range. And this is what you should expect. And I'm going to tell you, about 99% of the time, at the end of the day, what I told them on the initial consult is exactly what happens. That's because I've done it so many times. When you call these, late night TV, scare the crap out of you, call now, or else, the IRS is going to have their, foot so far up your yin yang that you can't smell. It, those people are selling a widget. They're selling the process. They want to get you into their process and start filing some things. But you need someone that can tell you, here's what you should really expect, and have some real level of understanding that what I'm telling you is going to be pretty accurate. And like I said, I'll tell people, and we can go back and look at my notes upon the initial phone call or my initial consultation, and I'll tell people, this is what you should expect. This is what's going to happen. This is what's going to cost you to get there. This is the changes you're going to need to make in your lifestyle, and this is the agreement that you should anticipate getting into. And this is the process that the IRS will accept. And I'm telling you, a really, really, really high percentage of the time, what I told them that initial consult is exactly what happened.
Okay, so next we have innocent spouse relief. So who qualifies? What is it? And how does it work?
So innocent spouse is where you have a husband and wife. One was a breadwinner, one was not, and there's a tax liability, and the spouse who did not have the income wants to claim innocent spouse and not be liable for the tax liabilities from that income. So that's kind of overall what the innocent spouse is arguing, right? I have a lot of clients that will say, hey, my husband made, $500,000 a year, and I didn't know that he made that extra money. I thought he was only making, $300,000 a year, but he had some, other monies he was making. And then now we have all these tax liabilities. We got audited, but I didn't know, and it's not fair. Now we just got divorced because of whatever reason, or we're separated, or we're not. And, I'm innocent spouse. Well, and I asked them, so where do you live? Well, I live in Paradise Valley in the, $1.5 million, $2 million home. Okay. Do you have a car? Yeah, I have a car. What car do you drive? Well, I drive a BMW. Um, okay. Did you go on vacation last year? Well, we went on a cruise and we took the kids skiing to Breckenridge. Okay, great. So how is it that you're innocent? Well, I didn't know about this income, but you benefited from the income. You have benefited from all of that income. It's not like you might not have known that it was the amount of income your husband was making, but you certainly spent the money and benefited from the lifestyle. So you're not innocent spouse. Who is an innocent spouse? Here's a perfect example, and this is a more recent client that we got approved for innocent spouse. So client was married to a man who had a business, made some income, but he also was involved in a Ponzi scheme some years ago that eventually broke down. And so all of that additional monies that he was pulling out was going to a separate bank account that my client never knew about. And that separate bank account was funding a girlfriend that she didn't know about. And but she was home with the kids, two kids, young kids, and she had a budget. So her name was on one bank account and not on all the others. The bank account that her name was on, a certain amount of money went in. It was enough money to pay the mortgage and insurance, the car payments, some groceries, and kids, things. And if she wanted to take the kids to go see a movie, he would give her some money. If she bought popcorn at the movie and he didn't authorize that purchase, when she got home, he would be mad that she spent the extra $42 for a bag of popcorn. Well, it's not that much, but,
At the movies, yeah.
and and slap her around. We have pictures of her having black eyes, and basically any time that she stepped out of line with finances, she got it coming to her. She eventually got out of that abusive relationship, and then all these tax liabilities show up. The point is, she never benefited from the income. She didn't know about it. She wasn't on the bank accounts. She couldn't see the deposits. She didn't know how much money her husband was making. She filed a joint tax return and reported a certain amount of income. She didn't know of the additional income, and she didn't benefit from it. She's an innocent spouse. And the IRS in that case took the liability off of her tax module, and she didn't owe it anymore, and she moved on, and the tax liability remained only with her former husband.
All right, so next we have bankruptcy. Obviously, this is probably one of the least desirable options, but an option nonetheless. So if you could let us know, when can you get rid of taxes through the bankruptcy courts?
Yeah, honestly, I don't know that's the least desirable option. It kind of depends on the circumstances. Sometimes it is desirable, um, but it is possible. It is possible to discharge tax debt through bankruptcy. A lot of people say you can't. You can, absolutely you can. But it's just not any tax debt. And so it kind of depends on what type of tax, and it kind of depends on how long that tax has been sitting around. So a client called me day before yesterday and said, I'm going to file my 2022 tax return. I'm going to owe a whole lot of money. I don't have the money for a number of reasons. I just want to file. I heard you can file a bankruptcy and get rid of taxes. And no, you can't file a tax return and turn around and file bankruptcy the next day. So here are kind of the rules. You, for income tax due, you can, that's for a tax year that's at least 3 years ago. The due date was at least 2 years ago, okay? And that tax return has been filed and the tax assessment has been on the books for at least 240 days. This is kind of the general, rule, the general guidelines. There's some other little details, but generally, if this is a situation, then you can file a bankruptcy to discharge that tax liability. Okay. There's some other little things, but what if it's not an income tax liability? What if it's a trust fund recovery penalty? So client owned a business, didn't pay the payroll taxes, FICA and FUTA, right? Now your forms 941 and 940. So you didn't pay your FICA, but you withheld, on your employees' wages, but you didn't pay that money over to the IRS. And so this is what we call the trust fund recovery penalty, TFRP. The IRS can take that tax liability from your company and make it a personal liability to any responsible party with knowledge, is the rule. So you maybe you were just the bookkeeper that came in, 3 days a week, half a day, and did the books, but you knew the IRS that the company owed the IRS and was not paying the IRS, and instead you were paying, rent and other things, but you didn't pay the IRS, and you were a signer on the account, and you were writing all the checks. The IRS is going to say you are a responsible party and you had knowledge. You could have paid the IRS instead of paying your rent, but you didn't. You could have paid the IRS instead of paying your employees, but you didn't. You paid, expenses instead. So you get a TFRP, trust fund recovery penalty. This is a trust fund tax. This is a special type of thing, and you can't just charge it in bankruptcy. The IRS is not going to compromise it very easily. This is one of those things that's kind of a special place in HE double toothpicks that the IRS does not like. And so there's only certain types of taxes that you can discharge in bankruptcy. But when we're talking about income taxes that have been on the books, and so when a client walks in my office and says, hey, I owe hundreds of thousands of dollars, from tax periods, 2011 through 2020. And by the way, 2011 through 2017, all of those tax returns were filed in 2019 because I didn't file for a long time. I was a non-filer in 2019. Someone came out, the IRS forced me to file my tax returns. I did, and I owe hundreds of thousands of dollars. I've been filing since, but I just can't pay it anymore. What can I do? And, that case, they can file a bankruptcy and discharge those tax debts. There are some other pieces to that bankruptcy issue, though. And it's a little bit more of a trickier, a situation than, what meets the eye. So if the IRS has not filed any liens, then once you file the bankruptcy, you move on. If the IRS has filed liens, though, and you have a lien against your house for tax period, 2018, in the amount of $50,000, and and you file a bankruptcy, and that $50,000 debt is discharged in bankruptcy, great. The IRS is not going to be coming after you for that debt because it's discharged the debt. However, that lien doesn't go away. The lien that was filed prior to you filing a discharge, so a lien recorded prior to filing a discharge, prior to filing a bankruptcy action, that lien will stay throughout the remaining statute of limitations. So, and we'll get that client that comes in, even though we file a bankruptcy, we discharge the debt, the IRS is no longer collecting from you, that lien still sits there. And so the client says, how does this affect me? And this is how it affects you. You're not going to be able to sell your house until the statute of limitations expires. So if you filed those tax returns in 2019, the statute of limitations expires in 2029. If you sell your house prior to the expiration of that statute of limitations of that lien, then when you sell the house, through the proceeds of the sale is going to first pay off that lien. So even though the debt has been discharged, the IRS is not knocking on your door. The lien remains until the statute of limitations expires. So a lot of times what happens is when people call, one of the first things that we do is we need to determine what is your collection statute expiration date. IRS calls it your CSED date. What's your collection statute expiration date? And once we know what that is for the different tax years, that helps us make decisions for what we should do. If we know that 14 months from now, that $300,000 of your $400,000 of tax debt is going to go away, well, we're going to take other actions to buy yourself some time to get past that. So now the $300,000 goes away, and now working out a deal for a $100,000 debt is different than working out a deal for a $400,000 debt, right? And so, so that collection statute expiration date is really important.
All right. So when you don't file a tax return, what issues do you run into?
Yeah, non-filers. So, sometimes those clients come to me and they say, I haven't filed in a long time and I'm just scared. And I know someday it's just getting to be a bigger and bigger problem. And I finally at a place in my life where I'm ready to face it. And sometimes the client comes in, and this is the more often scenario, when you don't file a tax return, but there are employers or people filing 1099s, W-2s, K-1s, 1098s, and things like this. So what happens is the IRS computer system is going to file a tax return for you. It's called a substitute for return. The IRS refers to them as SFR, a substitute for return. And so what will happen is the client comes in my office and says, I get this letter that says I owe $480,000. I can't possibly owe $480,000. I didn't make $480,000, in this time period. How can that be the case? And I say, well, did you file a tax return? Well, I didn't file tax returns. How is it that I owe $480,000? I say, well, I'll bet that the IRS filed a substitute for return on your behalf. And if we pull your transcript, we're going to see a 150 posting. It's going to be an SFR, and it's going to be the IRS basically filing a tax return for you. So we pull their transcripts, and sure enough, we see the SFRs, and the IRS has taken all of your 1099s and put them on a tax return and said, that's your income. We don't have any information that you have basis for the property sold, or expenses for the income, the revenues you obtain, you receive. All we know is you got these revenues and you sold these properties for X number of dollars. That's all income. And so that's what the substitute for return is going to do. And $480,000. And so here's the thing. When this happens, when the taxpayer files its own tax return. Then it will immediately replace the substitute for return. So you file your tax return, you say, okay, well, the IRS got 1099s saying I got $280,000 of income. Well, that was $280,000 of revenue that I had to pay for supplies and cost of goods sold and employees and rent and stuff. And after expenses, I only made $70,000. Okay, so you file your tax return, you show the $280,000 of revenue, you show your expenses, you have a profit of $70,000, and that's your taxable income. Or I sold a house and I have a $600,000 of income because I sold a house. Well, that $600,000 sale is not all profit because you bought that house, right? And so you bought that house for $400,000. So you have basis, and so $600,000 minus your $400,000 basis, your gain is only $200,000. And this was your primary residence. You lived there for 4 years, and then you sold it. Well, you qualify for Section 121 capital gain exclusion upon the sale of a primary residence. $250,000 for an individual, $500,000 for a married couple. And so even though your $200,000 gain on the sale, you have a $250,000 gain exclusion, so you don't have to pay any taxes on any of the gain. And so all of that goes away. And so what happens a lot of times when people haven't filed and they come in my office and they get these notices and they owe these astronomical amounts and can't understand how possibly that could be the case. The case is the IRS filed SFRs, didn't give you any deductions, didn't give you any basis, didn't give you the benefit of capital gain exclusion on the sale of your house and these types of things. And so when you actually file your own tax returns, you owe, $14,000, not $480,000. So when you file your tax return, your tax return replaces the SFR immediately, and the IRS can audit it if it wants or accept it as filed. And usually what happens is we're talking to a revenue officer, not a revenue agent. A revenue officer is a collection person. A revenue agent is an examination. That's a CPA that comes out and determines, do you owe money or not? The collection agent just collects the money. And so when you're talking to a collection agent, you hand them your return that you're filing through them, they process it, and then they move on. That return may or may not get audited. Very rarely it does. Sometimes it does. And then you move on.
Okay, so kind of moving directions here. I want to talk about some of the collection actions that the IRS take and kind of figure out like what is and is outside of the bounds here. So I think a burning question is, can the IRS take your house?
Yeah. This is seizure. So can the IRS seize your assets? It can. It isn't the first thing that they do, and it's not easy for them to take your house. So the revenue officer, the collection agent, has really got to go up to his group manager and get approval. And then the group manager's got to go up to their, district director or district manager and get approval. Then the area director and get approval. So they've got to go up a couple of layers and get approvals. And they've got to show that taking that house is not going to put you into an economic hardship. And almost always from the revenue officer's perspective is it never puts you in economic hardship, but but in real life it almost always does. So but they can seize assets. They can seize your qualified plan, your IRA, if they can show that you do not need that IRA to meet your personal living expenses. I've had cases where revenue officers absolutely know that IRA is the lifeline of this taxpayer, and that taxpayer has been using that IRA systematically over the course of 2 or 3 years since something happened, and every year there's 10, 20, $30,000 being pulled out of that IRA in order to meet personal living expenses. But that revenue officer, the knuckle dragger, we call them, will go to their manager, and that manager will go to the area director and say, no, this person does not need it. He can pay his personal living expenses without the IRA, and you've got to object to that and fight that.
Okay, so sounds like just because something is based on the way the Internal Revenue Code and the collection procedures are written, just because something might be out of bounds doesn't mean that an overzealous collection agent or revenue officer might try to do it anyway.
Yeah, they will try to do those things. Now, if you have a business, this is where it gets a little bit more uncomfortable. So clients will come in and they'll say, I cannot have them sweep my business accounts because at any given point in time, I've got outstanding checks to pay for materials, to pay for supplies, to pay my employees, to I've got projects. I'm in the middle of a project. I'll have clients that will make a deposit and give me 50 grand, and I'll put that money in my bank account, and that 50 grand is to go purchase certain things for that particular client project. It's not income to me. They've given me the money to go buy it, and then the IRS sweeps my account. I've got the 50 grand from my client, but I didn't buy the stuff that client thinks I was buying for them. I cannot have the IRS sweeping my accounts. And so this is, a danger spot when we have a business. Well, what about, can the IRS call my clients and tell them, hey, this business has tax problems, and do you owe them any money? If you do, pay the IRS. The IRS absolutely can do that. This is when you hear about the IRS is going to put you out of business. The IRS doesn't put you out of business very often. Their goal is not to put you out of business. If the IRS puts you out of business, you can't pay your tax debt. They want you to earn income. So, and we'll play on that. The IRS needs to allow you to generate income so you can pay the IRS, right? But there'll come a time, and there's overzealous collection agents who systematically go out there and they want to put you out of business. They're just mean, and there are some of those. They exist in every district, and they just have this new power because now they're a collection agent and they have the power to put you out of business. And by gosh, they got beat up enough as a kid that they're gonna go now hurt you, and or it seems right. So they can go talk to your clients, and so what, and that they want to, because this is what they start asking for. Hey, we need to see your books and records and your accounts receivables. For sure, I will never ever ever give the IRS a list of my accounts receivables. Who are your clients? I'm not going to tell you who my clients are. Let me see your accounts receivables. No, I'm not going to show you that, because that's what they ask when they are starting to build a file so that they can go really hurt you. They want that information for one reason, and one reason only. They want to go to your clients and say, hey, you owe that company, $2,700. Pay us. When can you pay us? And you need to pay us. Your clients are going to all leave you, and no one's going to hire you anymore because they don't want that kind of problem. And that's the way the IRS puts you out of business. They don't say, I'm going to put you out of business. What they do is they do that, and that kills your business.
Can the IRS talk to your employees without you there to get information about what's going on?
The IRS can, under certain circumstances. It kind of depends. If this is a criminal fraud, investigation, they're going to read you your rights. You're going to know you're under criminal fraud examination. But if this is a civil, situation, you were audited, now you owe a bunch of money, you haven't been paying, and they're trying to enforce payment, they're really not going to go talk to your employees. They might want to interview your controller of the company, the chief financial officer. And that is in the process. Remember, we talked about if we're going to get you into an installment agreement, the IRS wants a collection information statement. Well, as they're investigating the accuracy of that collection information statement, getting that documentation, they're going to ask to talk to your controller, your CFO, about, how does the accounting system work? What happens if you get a cash payment instead of a credit card payment? Who collects the cash? Where does it go? Who deposits it? Do you hold any cash in the house? So they want to talk to people like that. Generally, you're not required to allow them to talk to those people if you don't want to. And so normally what we'll do is, I'll interview those people, and then I will just have that conversation with the IRS and say, here's the answers to the questions. Here's how it works. And, or it might be, in some circumstances, it might be okay for that person to talk directly to the IRS with me there. The client, the owner of the company, them being present, that's not really helping any, honestly. It might even be hurting things. But having your tax lawyer at that interview, so that and what should happen if that ever does happen, the way it works out should be the your tax lawyer sits down with your controller and says, here's what's going on, here are the questions you're going to likely hear, what are the answers to that question, and let's understand, so let's kind of talk about it so you really understand what those answers are, how to accurately answer them, how to not offer additional information that's not being asked. And so we're going to prepare, just like any lawyer would, preparing a client to testify at trial. We're going to prepare that controller, that CFO, or that employee to have that interview, and then we're going to be there, and then we can. And what happens a lot of times, and let me tell you, when the IRS interviews someone, a client, an employee, whoever, the IRS has been trained to solicit an answer, not always that may be the correct answer, but they're trained to solicit an answer. And so the IRS is going to ask a question in a way that you think the answer is going to be, what you say, but the question really is getting to something different. And I know that. So I can hear the questions as they're asking them. I know what the IRS is really getting to. And sometimes, these aren't educated people all the time, very often not. And so the choice of words, how they say things, the choice of words are important. The details are important, right? And so what I'm doing when I'm sitting there during that interview is I'm going to stop after the question. I'm going to rephrase the question to my client, and I'm going to say, here's the question. And I'm going to point, the question into a, narrower scope and say, is this or is that not the case? Does it work this way or does it work that way? And let my, my client or the person I'm working with answer the question as I've rephrased it to them. And that's really important. This is why you should never, ever meet with the IRS without a tax lawyer present, because you don't know the purpose of the question. I do. And I'm going to rephrase that question to make it obvious to you so that you can answer the question that is going to be more accurate.
So you kind of serve it as a filter
Exactly.
between the agent and the client. That makes a lot of sense. Uh, Another burning question that some people have, especially when you owe a large amount, is will I go to jail for this?
Yeah. So you don't go to jail because you owe money. You go to jail because you've committed a crime. And is owing money a crime? Rarely. That, I mean, this man who's, I think today is his closing arguments for, the cryptocurrency guy. He scammed billions of dollars from people, and he probably owes lots of money. He might have committed a federal tax crime if he didn't report all of his income, and now owes a lot of money. But you go to jail not because you failed to file your tax returns for a few years, or you owe some money and file the tax return. You owe the money, you didn't pay it. That's not a crime. You go to jail because you hid income. So people that go to jail, they had their employees, all the money that was paid on credit cards or checks that went to the bank account, any of the cash payments, they took those invoices and they shredded them. They took the cash and put it into the safe. And at the end of the month, that money went to the owners of the company or whatever, or at the end of the day or week. Those are the types of things that happen where you go to jail, okay? Purposely not reporting your income and affirmatively doing something to hide that income. That is a crime. Reporting your income, but having already spent the money and now you can't pay the tax is not a crime. It's not a criminal offense, at least, right?
All right, so to wrap things up here, Whitney, what would you say is the number one rule when dealing with IRS collection agents?
Yeah, never talk to them without a tax lawyer. You shouldn't talk to them at all. And once you hire a tax lawyer, then let your tax lawyer talk to them. But you shouldn't be talking to the IRS personally. For sure, when the IRS talks to you, their goal is to solicit information from you that will harm you. That is the only reason why they want to talk to you. They want to solicit information that they can use to harm you. So do not talk to the IRS. And if you do, make sure your tax lawyer is sitting right next to you.
Thank you so much to all of our listeners for tuning in. It's been a great conversation. We hope you found it as enlightening as we did. If you enjoyed today's episode, please subscribe to TaxWit's Wealth Protection Podcast on YouTube and Spotify. And if you have a question, feel free to leave it in the YouTube comments. Don't forget to check out the show notes for links to resources mentioned in today's episode. You can find those on Whitney's website at sorrell-lawgroup.com. That's SORRELL-LAWGROUP.com. Twice a month, Whitney and I will be discussing other exciting topics that you won't want to miss. But for now, it's time to say goodbye. Until next time, this is your co-host, Benji Albrecht, signing off. Take care and keep building that wealth the smart and legal way.